It's been a bit of an exhausting week for me, guys, because as Jeanette said, I've been doing this it's coming up on 27 years right now, which I think you'll be amazed at how great I actually look. But it's been a long time that I've been doing this, and I've seen two other events like this from a perspective of where people had a lot of questions, and one was in 2002. And the other was basically 2008, 2009, and we'll talk about that a little bit. I want to try something if I could. Does this webcam work? Can you guys see me in a minute? Yeah. I should have probably fixed my hair up here, but.
I see. Yeah. Do you know how to see the questions so you can see their responses?
Yeah, I do, as a matter of fact. And yeah, you guys can see me good. And now that I'm looking at, wow, how bad I look. I think I'll probably turn this off.
You look amazing. Hush it.
Oh, just stop. Just stop. All right. I wanted to see, because when I'm answering questions or when I'm talking to you guys, I really would rather do it with the webcam on. So let me see if I can figure out how to go back to presentation mode. And there we are. Good. All right. So how I survived the Corona crash. Top 3 ways to balance your portfolio. The stock think tank, by the way, is my first product in quite some time, and we'll talk about that in a minute. But I wanted to mention that because I do work during the week as an analyst, as a trader. We have institutional white label clients that use our analysis, and essentially we work with a bunch of medium-sized firms that want their own analysis but can't really afford to have analysts. So that's what Path Trading Partners is. If you see me referenced as Path Trading Partners on TV, that's what that is. So the first thing I want to do is go through a quick risk disclaimer if I could. And I always like to take a second and explain what risk disclaimers mean. Essentially, when you're looking at this, everybody drops down to that bottom and says past performance is not indicative of future performance. And any representation of returns are reasonable assumptions based on risk, etc. I never want to dismiss risk disclaimers. And the reason I say that is because what they're basically telling you, I had a product a while back, that was about 15 years ago, where I was actually doing a product, and our first 3 trades that we launched in this new product were losers. And I got an email from a person saying, you're terrible, you're awful. The first 3 trades, I had $9,000 in my account, and now I have 0. And I remember thinking, who the hell told you to risk $3,000 a trade? It certainly wasn't me, right? And I started thinking about risk disclaimers, which is generally just put up there and everybody says, oh, you know, I put this up there because I have to, blah, blah, blah. I put this up there because I want to. And the reason I say that is because just because the last trade made money, or the last 3 trades, or the last half month, or the last 6 months, doesn't mean you're not going to get a situation like the coronavirus or any other black swan that could come along that could completely wipe out normal performance. And that's why it's interesting, as people involved in the markets, we're required to put risk disclaimers up. But I don't understand why, like, a roofer doesn't have to give a risk disclaimer. Something I always ask, like a roofer, if my neighbor puts a new roof on his house and I say, hey, that's a good roof, who did that for you? Like, you know, can I get his number? Yeah, here you go. And he shows up to my job drunk and puts on a terrible roof. I have to think to myself that past performance is not indicative of future performance. It applies to absolutely everything. And essentially what this risk disclaimer means is that if you try to put on excess risk that is not advised, or excess risk that is advised, and you choose to take that advice, that is on you. That's what that means. I give a lot of live speeches. I did about 16 of them last year, and I always try to pass out hand mirrors if I can get them before the speech. And I tell every trader to put that hand mirror on their desk, because anytime you have a winning trade, you get the credit. But anytime you have a losing trade, everybody looks to see what happened, what went wrong. And sometimes nothing went wrong. Losing trades are the complementary probability to winning trades. One can't exist without the other. Every time you have a winning trade, there's someone on the other side that has a losing trade. It's a zero-sum game. So by the same token, there's going to be times where other people have winners and you have a loser. Now, that doesn't mean that 2 people with different strategies can't have a winning trade at the same time. That's a whole nother webinar. So we'll talk about that. But please understand that if you take excess risk in something, that it isn't the educator or the mentor or the guru or the strategy necessarily. It is you that took excess risk. And you need to be able to take that responsibility if you're going to be an active investor or a trader. You have to be able to do that. And if you can't do that, you should at least drop off this webinar, if not any of the others. I'm sorry, I skipped a page. So who am I? 26-year veteran trader. I'm a featured analyst on Bloomberg, CNBC, CNN, Fox Business, etc. I'm a featured CME Group analyst, and I'm the chief market strategist at Path Trading Partners. If you ever go to the CME's website, you'll see daily videos with me on them talking about the markets, as well as being the host for the Pure Exposure Growth Series, which is an online show that we launched that we do once a month now. We hope to do more often, but our sponsors for that particular show are E-Trade and the CME Group, which I'm going to just do this one more time. That's why I am drinking out of this bottle. Okay, just to tell you guys. So the reason I put this slide up is because a lot of people will put "as seen on" in their emails. And I always like to tell people that I actually am seen on. Fox News to the left with Neil Cavuto. There's Bloomberg at the top right. There's CNBC on the bottom with Jeff Kilburg. Jeff Kilburg, by the way, is about 6 foot 6 inches tall. I'm standing on a box and he still has me by 4 inches. So it's always fun to kind of point that out. Then that one on the right where I look just horrible, that's also to show you that when I say I've been around for 26 years, I have been around for 26 years. I think I'm 31 or 32 in that picture. I don't know. But I was on Bloomberg. It goes back to the times where I used to feel like I had to wear a tie. I don't like that picture at all. So let's just move on. So in this presentation, I'm going to be talking to you guys about how I survived the Corona crash. And the first thing I want to tell people is that diversification is not the answer to how you survive something like what just happened. And then we're going to talk about prepping for the road ahead. And then I'm going to give you guys a private invitation to, again, I haven't had any sort of service or product in quite some time. So this is the service and product that we're going to do moving forward. It's a responsible product. It's a portfolio-based product. And it's a product that is going to be responsible and productive for the next 10 to 15 years. So that's why we decided to do it. So I'll talk to you about that in a minute. But I want to touch on, I think, what is the point that everybody would sort of gravitate to, and that is that diversification is simply not the answer to protect yourself from events like we've just been through, black swan events, or really any sort of market crash. So let's talk about why that is. And I wanted to point out when I talk about the Pure Exposure Growth Series and you're looking at the markets and saying what just happened, this was one of our shows that we did. And again, these are free, by the way. So again, not a pay-for product. So if you sign up for our Pure Exposure Growth Series, you'll get links to the show. They're free. They're on YouTube. We don't necessarily mail to these particular people that watch this. But if you look at the title of this particular show, it was the Black Swan live trading event. And we went live February 18th, right, which was prior to the sell-off. Now, that's not to say that we predicted a pandemic virus outbreak. We didn't. But it was the early stages of the coronavirus, and we wanted to try and figure out with these guests that we had if this was going to be an event that we should pay attention to. And the consensus was that it was an event that we should pay attention to and that we should prepare for from a market perspective. You saw when I turned the webcam on that I didn't prepare from a hygiene perspective in terms of getting a haircut early enough to be able to survive the lockdown that was just announced in Illinois. But going from where we're at on this particular day, I want to point out some bear market history because this is really, really, really important. Because right now, the amount of times that people are texting me and emailing me and calling me, and the number of interviews I've done in this past 10 days is probably triple what I normally do between CNBC and Bloomberg and Fox News and Fox Business and Yahoo and Cheddar, all these online platforms, even local WGN. If anyone watching here is from Chicago or ever remembers watching the Cubs on WGN years ago, I've done 3 WGN interviews in the last 10 days. And for a local station to call you that normally talks about weather and where Benny the Bull is going to be signing autographs as if there's not somebody new every year in that bull costume. For them to cover the markets, you know, it's at the forefront of people's minds. And every single person that's reaching out to me and every single interview that I do, they ask me where the bottom is and if they should be buying. If you look at the last 2 bear markets, and let me change this thing to a pen. So if this doesn't work, I'll stop doing it. If you look at where the past 2 bear markets now, the definition of a bear market is 20% from a previous high, right? 52-week high if you're talking about stocks, but you're talking about indices, they want to go back to the recent high and count 20%. So if you look here, yeah, it does make a circle, good. March of 2000, we hit a high. This is the SPY, by the way. The SPX would just be adding a 0 to this. So basically, if you see 155.75, the S&P was at about 1557.50, right? And on or about the month of March of 2000, we hit a high in the S&P. And then on February 1st of 01, we dropped down 20% from that high, right? That is an official bear market now. We entered a bear market at that point. So moving forward, when people say, okay, well, where's the bottom? Well, the bear market low, okay, again, you entered at a price of about 1246 even in the S&P was the bear market entry point. The bear market low was about 770 in the S&P. That was a 38% decline, and it took 20 months to get there. 20 months to get down to that bear market low. This time to round trip reversal is how long it took the market to get back to the bear market entry price. And that was 80 months. It took 80 months to turn the bear market around. So what does that mean? Does that mean we got 80 months coming? Maybe. I don't know. Let's go back to the most recent bear market. And by the way, notice this first one started in 01. The S&P 500, if you're an indexer, if you're somebody that just buys and holds, the S&P 500's return profile is as follows. About 7 to 9% a year if you're not reinvesting dividends. About 9 to 11% if you are. And then every 10 years or so, it drops 30 to 50%. That's the return profile of the S&P. I ran a fund of funds for about 6 years. I was one of the partners and I was on the investment committee. If you would have put that return profile in front of me in the fund of funds, I would have crumbled it up, thrown it in the garbage can, and asked you to leave my office. There is zero chance we would have invested in that kind of return profile. Now let's look at the most recent bear market, not counting the one that just began. Okay. October of 2007, we reached a high in the S&P very close to the previous high of March of 2000. It was about 1575.20. Again, this is the SPY, it's the ETF. So it's 157.52. By January of 08, we had fallen 20% down to about 1260 in the S&P. That's 20%. You've now entered into a bear market. The bear market low was 6710 or 671 even on the S&P. That is a 46%, almost a 47% decline from the bear market entry. Now remember, it's 20% to the bear market entry. So it's way more than 46% from those October highs. So how long did that take us to get there? 14 months. Once we entered a bear market, it was 14 months till we hit the low of the bear market. And then 36 months to a round trip reversal, meaning getting back to 1260 in the S&P. Now, for everybody that calls me and says, should we buy now? Where's the low? I should say this. I have no idea where the low is. And by the way, neither does anybody else. I'm just not afraid to say it. So in February of 2020, we hit the all-time high for the S&P, and the bear market began in March of the same year. The entry price was about 2,712 or so on the S&P. Where's the bear market low? I don't know. Now, I will say this, the reduction of time that you see in this column, okay, 20 months to the bear market low, 14 months to the bear market low, from 2001 to 08, what was different? And it was central bank intervention. That's what was different. So if I had to guess, the time to the bear market low is going to be less than this. And the round trip reversal is going to be less than this, if I had to guess. Now, again, I'm honest enough to say it is a guess. But it is kind of important to understand that while everyone wants a V reversal, it isn't necessarily what's in the cards going forward. So why would anyone want to ever be in stocks? Well, really, stocks are the only way. Okay, they really are the only way. If you basically said to somebody, why wouldn't you invest in stocks? We're going to look at these three arrows. All right, well, yeah, there's a decline. Let me pull up a highlighter here. There's a decline here, and then we basically went all the way up, and then here's the decline that we're currently in. But if you actually want to take the time to just actively trade and miss all of this, that's okay with me. I understand that. But from a portfolio perspective, that's probably not the best idea. Okay, from a perspective of where your money should be once you make it, that's not the best idea, to miss all of this while you're just actively trading. So that brings up the question, is how you defend against black swans. And here is the chart that most people are looking at saying, yeah, but I don't just want to buy and hold. And they're not wrong. Okay, they're not wrong at all to say, I don't want to just buy and hold here. Okay, I'm just going to answer this because I know this person. Prior bear market times, Fed could lower interest rates. They don't have much ammunition now. Can we still expect Fed action to effectively bounce up in the markets? Yes, we can, because that assumes that the only tool they have is lowering interest rates, and they have more tools than that. For example, by the way, I'm not commenting on whether these things are good ideas or bad ideas from a political perspective or anything like that, okay? And that's not what I'm doing here. My job is not to say the Fed shouldn't be involved or the Fed should be involved, etc. My job is to say what's going to happen. By the way, the person who answered me that question, I've had several conversations, or asked that question rather, I've had several conversations with her, and what I tell her all the time is, why is the weakest or least empowering question for a trader or an active investor? The most empowering question is what? And the reason I say that is because you should be saying, what is happening and what am I doing about it? Don't ever look at why it's happening. Don't worry about why the Fed is doing what they're doing. Just worry about what the effect would be, and we get that from price action. So when you look at these drawdowns on this chart, 2 of these are black swans. Actually, 3 of these are black swan events. If you don't know what a black swan event, essentially for centuries, people thought only white swans existed. And then one day there was a discovery of a black swan, and it turned zoology on its head. So that reference has now been referred to as something that we should have expected but didn't. That's what a black swan is in simple English. An event that we should have expected but did not. So what happens if you're looking at the market from this perspective now with these circles, and here you're saying, I've got retirement money, and then this is your retirement date. Or here you say, I've got enough money for my kids' college, and then here's when the first bill is due. Or here you say, I want to pay off my mortgage, and then here's when you decided to do it, etc., and really, etc. Right? That's the problem with buy and hold. Now, everybody that's on this webinar has the ability to succeed as an active investor on some level. Everyone does. That's not a made-up comment. I'm saying that from a perspective of, I don't care if you join our service or not. I'm saying that from a perspective of everyone here has the ability to succeed in active investing on some level. It's up to you to find that level. and it's up to you to be responsible with the profits you make. Buy and hold is not the way you do that, though. It isn't, because you cannot decide or predict when these events in the circles are going to happen, and especially when this event with the arrow right here, this one, is going to end. We have no idea when that's going to end. So, why do I say stocks are the only answer? Well, to explain that, we have to talk about first why bear markets hurt so much. And this is what people get mad at me for this sometimes. Trading is not about how much you make. It's about how much you can make with how little you can risk. The most important thing for a trader or an active investor is to think about risk first, and then think about risk second, and then think about risk third. That's the most important thing for an active investor. And why is that? Well, let's focus just on the little columns to the right here, okay? These columns here. All right, now I wrote all over them, but let's focus on those. Right now, the S&P is down somewhere in the range of 30% or so if you go from the entry or from the high down to sort of the bear market lows, between 30 and 40%. In order to make that loss up, let's just go with 30%. The S&P has to return 43% to make that loss up. 2019, the S&P returned 29%, and it only returned 29% because the end of 2018 was a debacle. So it was starting from a low base. But let's just take the fair numbers. 2019, the S&P returned 29%. You still would not have returned the entire 30% that we've lost so far. You'd have another 13% to go. Simple way to look at that. Why is that? Okay, it doesn't really make sense when you talk about it, but when you see it in real plain, easy numbers, it does make sense. And forgive me if all of you guys understand this already, but honestly, I'm not that smart, and it took me a long time to understand this. If you have $100, okay, and you lose half of it, you've got 50 left. You've had a 50% decline in the money in your pocket. Now, in order to get back to $100, what percent of 50 do you have to make to get back to $100? 100%, right? When you were at $100 and you lost 50% of that, you were left with 50. But if you have $50 and you want to get to 100%, you have to double it. So that's basically, again, why this particular metric works, or why this particular graph works. You can go along the graph and look at the flat loss curve that we got here on this graph, right? These are very slow, steady losses down to a 90% loss. You have to return 900% in order to get back to even if you've lost 90% of your money. There's been some good traders on this show. I don't think any of them, including myself, can return you 900%. So you got to be really careful with the money you have. You might hear me say this again in this particular instructional video, so to speak, but there's only 3 possible outcomes of every trade: a win, a loss, and a break even. 2 of those are good. You guys guess which one are the 2 good ones? You know what? I'm not going to wait for y'all to type it in. Y'all know what it is. It's a win and a break even. Both of those are good. Now, if you skip a trade because there's too much risk, that's a break even trade. You started out with $10,000 in your account and you didn't take a trade and you ended with $10,000. Now, I'm not encouraging fear of avoiding trades. It's not what I'm encouraging. What I'm saying is you have to put on every good trade you see, and you have to manage those all from a perspective of risk. Frank just said break even is a win, and I totally agree with that. So, stocks are the only way, but diversification is not the only way. I would argue that it is not a good way. When you're looking at just a diversified 10-stock portfolio, okay, and I just put one together here, and I picked a bunch of different sectors that you guys might be involved in. So you got 3M there at the top, which is industrials. You got Disney, which we all know, it's communication services. AMD is chips. Peloton, consumer discretionary, if you've seen those annoying Peloton commercials. VLO is energy, that's Valero. Facebook, Bank of America. KR is actually Kroger, groceries. DD is DuPont. And then BHP is BHP Billiton, the mining company. Most people will buy a set number of shares when they put together a portfolio. I was talking to a friend of mine and I said, you know, I really like this one company. Actually, I don't mind telling you guys what it is. Teladoc, it's TDOC is the symbol. I really like TDOC. And he goes, all right, I'll buy 500 shares. And I said, then why 500 shares? He goes, that's how many I buy. I said, what the hell does that mean? What do you mean 500 shares? What's the risk on it? I don't know. You like it. So I'm going to buy 500 shares. I always buy 500 shares. That's ridiculous. Look at the exposure column to the right here. If, for example, you bought 25 shares of each one of these things, you have $21,000 of risk, right? Actually, let's just go ahead and take a look at it. If you have, now I'm going to go back to this. Imagine if you make money on Peloton and you make money on Bank of America and then you lose money on 3M. Your exposure on 3M here is way more than your exposure at Peloton and Bank of America and Kroger combined, because you want to do a balanced number of shares because that's what's easy. That is not risk management, but it is diversification. You are diversified. I mean, look at the sectors, right? 2 communication, 1 is consumer discretionary, 2 materials, you got financials, you got energy, you got industrials, you got IT. That's a diversified portfolio. But look what happened to the diversified portfolio over the last couple of weeks. Every single stock lost except Kroger. Why did Kroger make money? Because everybody was buying toilet paper. They just bought it out so people are buying Kroger stock. What people don't realize is a lot of people are going to stay home and not go shop at Kroger. So Kroger's probably going to lose when the rest of these come back. But that's a fundamental case. That's a why, and I don't really care about that. So this diversification model didn't work. Here's an example where you have that same model where you have 25 shares of each, right? That same model. Here you have 4 losses of 50% and 6 gains of 50% down at the bottom. Can you guys all see that? If you have 10 stocks and you're 60% winner in a 1-to-1 risk to reward ratio, you should make money. And because this particular person wants 25 shares even because it's easy, this person actually lost money going 6 for 10 because the risk is not balanced. That's a problem. That's a massive problem. So when you're looking at diversification as being the only risk factor, that's not right. So what's the proper way to look at things? Well, the proper way to look at things is to have actual risk involved. So what if you said, okay, I'm just going to go ahead and do 2,000 shares of each. I'm sorry, $2,000 worth of each stock, right? Is that a better way to do things? Well, yeah, it is. It's a little bit better, but that assumes your risk is to 0, right? That your risk is all the way down to 0 with all of these stocks, which we all know nobody does that, right? Nobody does that. Everybody just basically says, well, you know, if it goes down too far, I'll get out, or if I lose too much, I'll get out. So if your risk metric says I'm just going to buy $2,000 worth of each stock, you end up with this breakdown right here in terms of the amount of shares you would have. Okay, right here. You can see the exposure down to 0 is about 2,000 of each. So what happens in that kind of a portfolio if you have similar production? Well, let's look at an example of 5 losses, 50%, and 5 gains of 50%. Yeah, you made money, but because of the different stock prices, okay, and the 1-to-1 value here, you made very little. So that brings us to the proper way to manage things and how I personally survived the Corona crash. It's by limiting risk without limiting reward. So I'm going to take you inside of what risk is and how it works. Okay? Don't lose money is misconstrued. It's a myth. Every trade doesn't have to win. And if you just use simple math and basic probability and limit your risk first to a specific reasonable percentage of capital, it reduces the drawdown effect during corrections, or worse, during a COVID-19 sell-off, a bear market. You limit the maximum loss to both an individual stock held in your portfolio as well as the loss to your entire portfolio. And long term, your successful trades will win more than your unsuccessful trades will lose. So what we've got here is an example of a $20,000 portfolio. Okay, you can see here, let me get the pen up again so I can talk to you guys about this more. Now, again, this is fictional right here. This is not an actual trade. I need to make that known. This is just a made up example. And I had that in the disclaimer. If you would have read the disclaimer. So it's a fictional $20,000 portfolio, okay, for Aaron's, which is a furniture rental company. That's AAN. By the way, they're also a lending institution. So it's actually a really good stock a lot of the time. But in this particular example, you're looking at 0.25% of risk per trade on a $20,000 portfolio, which translates into $50 per share. I'm sorry, per trade. Now, why does somebody want to do that? Well, the reason you want to do that is because you want to do it by percentage, because as this number goes higher, this number will go higher. And this number here will stay the same. That number doesn't change. So that means while you're winning, you start to risk more. And while you're losing, you start to risk less. What does that do? Well, in a losing streak, it extends your life. It keeps you out of a situation where you've lost 90% and now you have to produce 900% to get back there. That's what that does. Honestly, just hit a quick hand raise on this one. How many of you have heard traders say, live to trade another day? Oh, I got out and I lived to trade another day. There's got to be a million of you that have heard this. That's exactly what this kind of thing does. Because when you go by percentage of investing capital, if you're losing, this dollar amount shrinks. Now, what if you say, I'm going to risk $50 per trade? What ends up happening? Just think about it logically. If you're going to risk, I always risk $50 per trade. Okay. Well, when you're down, when you're doing a 0.25% and you're risking, and it turns out to be $50, if you risk $50 per trade and this number drops down to 10,000, right? What percentage are you risking now? You're risking 0.5%. Your risk just went through the roof. It doubled. Your risk doubled. Is that what you want? Not really, because you want to survive in times like we're in right now. You want to survive and you want to protect capital. You don't want to chase. You want to be involved, but you want to survive. So back to this point, in this particular example, the position size is dictated by the percentage of risk of capital you have available. And critical, the stop price. Now, a lot of people don't like to put a stop into the market. We don't either, and we don't. But that's something for another time. Basically, what you do in this situation is, this is an already predetermined formula. It's simple math, right? My entry price on Aaron's was about $44.50. By the way, we did actually do this trade, but this is an old slide. My entry price on Aaron's was about $44.50, and our stop, where we knew our pattern no longer held water, was $40.95. So that's a risk of $3.55 per stock. Now, in the prior example, where you just say, I'm going to buy $2,000 worth of stock, what's your risk per share? $44.50, because that's your entry price, right? But here we're risking $3.55. So we get the same effect of leverage, but without the risk. because we put on more shares, but we have a set price where we're done with this trade. The pattern is nullified. We're no longer in it. So in this case, the capital we have to allocate to buy the stock is only $626.76 because we buy 14 shares based on this equation. What is our risk per share? $3.55. How many shares takes us to $50 of risk or less? 14. That's the simple math. That's the simple math. And I'm always amazed at how many people don't realize they've been trading 5 years, 10 years, 20 years, and they get into this habit of just taking the easy way, of just doing the easy thing, of saying things like, well, I always buy 25, so that's what I'm buying. Well, in a time like this, let me pull up a chart really quick. How many of you guys can see this chart when I pull it up? It's been a long time since I've used GoToWebinar. All right, this is bar chart. It's a free service. Can you guys see this chart? I only need like one of you to answer. Actually, I'm able to. Okay, good. Joe answered. Joe answered. No one else has to answer. Okay, this is Tesla, right? Probably not the best example. But if you look at this area right here, okay, versus this area right here, does area 1 or area 2 have bigger ranges? It's obvious. I'm sorry. It's area 2, right? Area 2 has much bigger ranges. So, which area is riskier? It's area 2. Okay. Again, easy answer. But let's say that area 2 has 10 times the risk of area 1. Okay. If in area 1 you put on 25 shares, sorry, I want to get my pen back. In area 1 you put on 25 shares, and in area 2 you put on 25 shares, where are you more likely to get stopped out on? Which area? Area 2. But the movement is actually normal for recent volatility. But now what if in area 1 you put on 25 shares, but in area 2 you put on 12 shares? You're going to lose about the same amount of money if you get stopped out, right? Actually, you lose a little bit less in area 2, but also there's more probability for slippage. So it'll probably be about the same amount of money. That's what position sizing does. In this area, you put on 25 shares. In this area, you put on 12 and you sleep at night. You have no fear because it's the same risk you've always used. People have been saying to me through this event right now, through this black swan we've been going through, are things are crazy. I'm like, not really. They're not really that crazy for me. And this is why. And it's so simple. Now, in a case of area 1 here, right? If I bought here, I might put a stop below here, okay? Look how small that area is. But in area 2, if I bought here, right, I might put a same stop just because of the volatility. And look how much bigger this area is than this one is. But because I have fewer shares on, the risk is the same. The risk is the same. And I don't lose my mind. And I don't, more importantly, lose my ass. Right? So Peter just threw in, what about a trailing stop? That's exactly what we do, Peter. So I'll just mention that now. We trail stops when we're winning. You don't want to trail stops when you're losing because that means you're increasing the loss. And I'm pretty sure that's not what you meant. But we don't trail stops when we're in a losing. Our losing stop is our losing stop. But as a trade starts to go our way, yes, we tighten up our risk. So what I'm trying to say is that when you go to this perspective, you're going to lose the same amount or less. So look at this example I've just put on the screen. Portfolio based on balance and limited risk. So in this particular case, right, in this particular example, I've put on, it's the same diversified portfolio, which by the way, you don't need to diversify when we're using this model because we're trying to outperform, right? Here's the entry prices. And by the way, these are actual stocks, right? These are actual entry prices from that particular date. And these are stop prices, okay? February 17th entry, that was the day of the Black Swan event that we did for pure exposure. Here's the risk per share on all of these based on the stop that I chose, which is right here. So it's really just the difference between this price and this price, okay? Let me erase some of this stuff. So the risk per share is just the difference between the stop price and the entry price, okay? Difference between this and this is this. So in this particular portfolio, 25,000 portfolio example, if I only want to risk 10% of that, or 1% rather, it's going to be $250 or less. Look at this risk exposure here. It's all the same, give or take $1 or $2. It's all the same. So if one trade loses, it doesn't kill your portfolio like it does when you have a diversified portfolio, but you have your risk all skewed to one side. That's the point of this. That's how you survive these things, right? So how do we prep for the road ahead then? All right, because again, everyone's asking me where the bottom is. Well, this is how you prep for the road ahead. What is the value of your investing portfolio? How much money are you using to buy stocks? You establish a risk per trade, which in this case 0.25 is 0.25%. And that determines your dollar risk per trade. Okay. If you're trading 0.25%, okay, on say a 10 stock portfolio, 20 stock portfolio, your total risk, your maximum drawdown is 5%. That's if every single stock loses. That you can recover from. So you set an entry price and an initial stop price, and that creates a risk per share value. And that per share value determines how many shares you should own. The number of shares determine how much capital you allocate to any single stock, and this reduces the danger of single stock damage to your portfolio. You know what we're doing right here? We're actively investing and trading like professionals. That's what's happening here. That's what you're doing, the way that professionals do. You know what I really love? When guys come on and they say, trade like a bank trader. That, whenever somebody says that, they've never worked at a bank. And I've worked at 4 of them. Okay. This is what hedge funds and banks do. That's what risk managers watch when their traders in a bank are doing something, or in a hedge fund. Banks can't really trade anymore because of Dodd-Frank. But when you're at a hedge fund or an institution that can trade, the risk manager is basically saying, you're exceeding your risk, so we're shutting you down. Whenever you hear about rogue traders, those are guys that have thought of ways to exceed the risk in a way that sort of cloaks it from the risk manager. That's what happens. Now, I hate this part, to be honest, and Jeanette and everybody will tell you that I hate this part, but I guess it's important that you have to hear what followers are saying. And because I haven't had a product in 15 years, this is actually somebody, Nick Bovell is a hedge fund manager that I taught how to trade along with my partner, Mike Arnold, years ago. And this is something he wrote to me in 2009, right? Good afternoon, Mr. Drapella. I was thinking about enrolling in an online Forex trading course run by a well-reputed market analyst, Bob Iaccino. Wow, this is 11 years ago. The course is about $700 US, but I think it will give me a good foundation. What do you think? Perhaps a worthwhile investment. The reason I have this is because he reached out to me on LinkedIn recently and said, you can see his LinkedIn right there. And by the way, you can connect with him and reach out to him if you want. Chief Investment Officer at Bovell Global Macro. He's in Australia. He runs his own hedge fund. And he goes, 10 years ago, thanks for being my first trading mentor. And thanks for not being a scammer like 99% who are out there. And I said, thanks, Nick, after 10 years, blah, 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 whatever. You guys can read this. I hate this part. But this is an actual hedge fund manager that learned from myself, my partner, Mike. And now he has a multi-million-dollar hedge fund that he runs. And that's because what I try to show you guys is what hedge funds actually do and what institutions actually do. Not what some guy in his garage figured out that might work for 5 years, right? You don't survive for 26 years by not knowing what you're doing. Here's my friend Mimi, who is a friend, but I met her at an event I spoke at. You can see this recent one is from February of this year. Excited for my mentor's live trading session tomorrow. By the way, look at that date, February 17th. Mimi actually showed up at our Pure Exposure show and said his calls have been spot on. And then here's another one. I don't know the date on this one. It says 1 hour ago. Wow, bought CL at 61.50 and sold at your target of 64. I think this was a trade we talked about on the show. I think that's what this was. Anyway, yeah, I hate this stuff anyway, so that's okay. But also, I asked Mimi's permission to leave her Twitter handle on there, and you can reach out to her as well and ask what the kind of things we talk about, what value that has to her. She's fine with it. Yeah, the market fell. The market fell, but again, look at the tweet. Bought at 61.50 and sold at your target of 64. That was a trade. What you're trying to do as an active investor, by the way, guys, is you're trying to, you're basically just trying to take portions of moves. You're not trying to ride things to their eventual point. But that was basically it. Okay, so Mimi's here, and she actually just said I was all in cash when the markets fell, which is good. It's very good to hear. So basically, we're launching the stock think tank, and this is where we're launching it. All right, we're launching it on this particular presentation right now. And essentially what we're doing in this presentation is doing a 10 stock portfolio. Now, this particular portfolio that's on your screen right now is the portfolio that we currently have, and there's the entry dates. Okay, so you can watch this with us right now. If you want to screenshot this, go ahead. All right, and what we're going to do in the stock think tank is we're going to save you guys from going it alone. So basically, we're talking about this particular point in time being too important to go alone, to go at it alone. And that's why we put together this product right now. So this report that we're doing, the Stock Think Tank, which is available to you guys right now, you can see it at stockthinktank.com/thirsty, is a 10 stock portfolio where we employ the strategies and the risk factors that I just showed you in the prior slides. Okay, that's what we're looking at here. Now, what you're seeing down at the bottom there is special plays, which is part of what we're doing. So what we're doing in the Stock Think Tank is a top 15 stock portfolio. Now, the core portfolio is going to be 10 stocks, all right? 10 stocks put together as a core portfolio with entries and specific instructions, the initial stop with specific instructions, and then targets moving along toward the curve. So Frank actually said, what about trailing stops? That's what's going to be involved in this. So when we talk about limiting risk and limiting position size, you're going to get all of those in the Stock Think Tank. We're going to give you the stocks to get into, the prices you should get in them at, the initial stop levels, and the math for the position size that you should put on based on your portfolio that you choose to allocate to this. All right, you're going to get weekly newsletters, daily alert emails with trade position changes, new positions, and they're all going to include entry and stops in the initial email, and then targets as necessary, right? And then there'll be VIP updates based on market movement. What do I mean by that? Well, if we get another event to the upside or to the downside, I'll put something together and we'll present it to you guys live, or we'll send it out in a newsletter as to what the new situation is and what it means to what we're doing. Again, notice that I say what, I don't say why. If somebody reaches out to me and says, why is the market moving like this? I don't know, it's a cloudy day. I don't really care. The right thing to do is to process information and figure out what you're supposed to do with that information. And what the Stock Think Tank does is it makes that idiot proof. It takes it out of the equation, completely out of the equation, okay? Completely out of the equation. So by the way, while I'm talking about this, feel free to throw in questions. What does this say here? It's Frank. I was on your morning webinar series for a long time. I traded Forex. I'm still trading Forex. That's what I mean, Frank. Survival. Frank took one of our early 20 years ago Forex classes or whatever it was, and he's still trading. That makes me really happy. What if I want to establish a portfolio of solid companies with dividends for retirement? I'm fine with that, Paul. Just go ahead and take what you learned about position size and risk, and you can do that. Some of our stocks in this portfolio will have dividends and some won't. This is really just about performance. So let me go over what we're trying to do with this 10 stock portfolio, and then I'll go back to questions. Essentially, the 10 stock portfolio is designed, and actually there's a video in the members area that's talking about this. The 10 stock portfolio, it comes off of momentum, underperformance, and value. So stocks that tend to outperform the market but may not be doing it right now, and value with the stocks themselves. And sometimes that value includes dividends, okay? Sometimes that value includes dividends. Neil said you never gave any info on your past and present performance. Neil, that's a great comment, and I hope you're still here to hear the answer to this. What happens if I give you 3 months of performance? Does that mean shit? What happens if I give you 26 years of performance? Does that mean anything? Does that mean you can replicate it? Is that why people put disclaimers that say past performance is not indicative of future results? Are you able to replicate my performance by doing these 10 stocks? No, you're not, because it's not all I do. Now, I can tell you that I've been trading for 26 years and I've been on TV since 1999, or I could put up, here's my past performance, and you could just damn well believe it or not. I always laugh when people put up performance. I always do. Because it assumes that first they put up a disclaimer that says past performance is not indicative of actual results, right? Then they essentially say that there's no past performance you can rely on. Like Traders Reserve Millionaire Blueprints was a member. Yeah, Alan, I hope you become a member of this. And that's all I'm going to say about that. I really do. So anyway, currently, Neil, I hope you're still here. I don't mean that as anything negative towards you. I mean it as something negative towards the industry. I really do. I really, really do. I mean it as a negative thing toward the sort of education industry. Because when somebody says to you, here's how I've done the last month, dude, have you seen the moves the last month? Does that mean anything going forward? It always cracks me up when people do that. You have to put up a disclaimer that says past performance is not indicative of future performance or your performance. Then everybody wants to see performance. 27 years I've been doing this and have not had a product for most of that time. So how do you guys think I survived? Top 15 stock portfolio, weekly newsletter. This $497 introductory price is 12 months worth of this. Okay, so keep that in mind, right? It's not 1 month, it's 12 months, all right? Neil says, I understand, but how can I judge you're different than other promoters in this industry? Reach out to Nick Bovell, reach out to Mimi, reach out to CNBC, CNN, Bloomberg, reach out to anyone that knows me, Neil. That's all I can tell you. If what you're saying is, how am I different than other promoters in this industry? I would say by not having had a product this entire time, I'm different than other promoters in this industry, but that's okay. I again, don't like our best client in this particular product would be people who are jaded from other products. That would be and that's exactly what Neil is. And you can tell Neil has been, Jeanette, can I cuss? Or is that a bad thing? I don't know if I can cuss or not.
I'm not going to tell you what you can and can't do. You just,
Neil has been effed over. Neil has been effed over before, and that's why he says these things, and I can appreciate that. I hope you join, Neil. I really do, because I'd like to talk to you more one-on-one. It's not fair for people to put out strategies that they've worked on and things that do you realize that, like, for us to give our strategy out, how much money we had to lose to develop it? You realize how much money was lost developing a strategy? So somebody actually asked a question that I was positive we would get. Do you think this will work on options or only stocks? You can get performance out of options from this, Will, but my problem with doing that is that we can't control your risk metrics in options, and we can't control your time frame. So since we're not giving out options picks, we can't tell you to buy the June options or the 1 week options or the 6 month options. You would have to decide that on your own. So yes, it can, but you just, the risk part, it's up to you which options you're buying or which options you're selling. Like if we put out a buy pick and you're selling puts on that and it goes through our stop in an aggressive move, we're out, but you're not, right? Your naked risk is yours. So that's I love that question, by the way. Do you also trade short or only long? Robert, this particular product will be long only. It's a portfolio product, but you can expect that we'll put out a product as well that not only, and we haven't done it yet, but not only uses options, but also protects on the short side. And when you look at the 15 bonus picks, let me go back to that slide if I could. See down at the bottom here, how there's 3 picks. These are unusual picks. This is TDOC. I already said that's one of my favorite stocks right now. USO is an oil ETF, and this is back to Neil's question. I won't actually do the oil ETF. I'll do the WTI futures. A lot of you won't be able to do that. So like my performance will be slightly different than yours. USO is a oil ETF. And then SLV is a silver ETF. I will actually do silver futures, not the ETF, but that just depends on portfolio size. So Neil, if you're still here, that's part of why it's different. But these picks down here that are called special plays, every once in a while, if things are just horrible and we don't have 10 stocks in the top half of this page, we'll probably have some longs in some short ETFs, if that makes sense to you, right? So there you go. Anyway, moving from there. Here's another question. Is there a minimum portfolio size? I don't think I covered that yet. I don't want to say there's a minimum portfolio size. We're going to be tracking a $50,000 portfolio. Just know that if you go in with, I would say that the absolute minimum is probably 20K, but if you you can do it with less than that. There's just going to be some stocks you can't get into because of the risk metrics. One thing I would recommend is not putting your portfolio size and risk size into the stock sheet, and if you're into the risk management sheet. And if it shows you a result of 0 shares, don't put that trade on. So while the people who might have the entire portfolio on, you might only have 6 of them on because the price of the stock is just too much. All right. Somebody said, I missed it, but do you hedge this portfolio? Michael, the hedge is the stops. Okay. You're free to hedge it if you want. But what I would say to you is that the hedge is the stops. Okay, that's how we get out. We have our position size correct, and then we get ourselves out of trades that aren't working any longer. All right. Let me go back to the offer sheet here. So if you join up now, you'll be on a webinar March 25th at 5 p.m. Eastern time, where I'm going to do some live market analysis, some trade updates, and some live Q&A. Now, this is something that's said a lot. This introductory price actually is not going to last. This is a new product. Okay, this is a new offer. We haven't started this yet. So this actually is an introductory price. And you will go to the website later and see a higher price here. Okay, you will see it. So from a perspective of whether the price is actually going to change or if this is just another one of those marketing things, yeah, you won't. This isn't the price. This price will go up. We are late to the current portfolio. What's next? Well, if you join, you'll get that, Alan. And by the way, for the new members in the current portfolio, we will actually put out special recommendations as to whether you can get into these stocks or not. All right. So it'll be a perspective of, can you still get into the stocks that we are in? And we'll give you parameters around that for the new people that are joining. Michael says, I missed it, but I got that already. Do you trade and take profits or invest? I tend to trade and then find another trade. We take profits, Rick. Now, in some of these trades, we'll have trailing stops, and those trailing stops will eventually get to a profitable level. And then that's what we'll do is we'll take profits when they go through the stop. Okay. So yes, we take profits. Mimi says they should watch the Pure Exposure Growth series so that they can see how you think and process. Yeah, if you want to, the replays of our Pure Exposure Growth series, which again is a free thing, you can see our thought process and how some of the people that I'm connected to think as well. Are you still trading Forex? I trade FX futures every once in a while, Alan. I'm sorry, Frank. Yes, I trade FX futures. How often will we provide updates? Daily, five to 6 days a week. The 6 day a week update is you'll have excess updates. But in terms of what you should do, you'll either get an email or it'll be in the members area that says you now want to do this trade, or you'll get an email that says no action to take today. So that'll be daily. Where are the updates given? Members area and email. Probably eventually it'll be we'll probably do SMS at some point, text messages. But right now it's going to be emails and in the members area. Now look at this. Can you guarantee performance? I will say this for the person who said, can you guarantee performance? That's an interesting question, Neil. I don't know. I'm sorry, I'm jumping into another question. Is the price locked up after the year access is up? I think it is. I think if you join now at 497, it's 497 every time you renew. But I honestly, I don't.
That's right, Bob. And if they don't, they'll have an option to renew. It won't be a forced renewal.
Okay, so you'll have an option.
They can say they want to stay on or not. We don't force renewals.
Thank you, Jeanette. So it's not an automatic renewal necessarily. And Neil, yes, you'll be locking in that price. What question was I answering? Guarantee performance. Here's what I guarantee. We're going to outperform the S&P to the upside, and we're going to protect you to the downside. I think in this following 12 months, we're going to return 15% or more. That's what I think we're going to do for the person who asked if we can guarantee performance. How often are new stocks added to the portfolio? I'd say probably on average twice a week, but don't hold me to that because, look, we're trying to hold 10 stocks in the portfolio, but we're not necessarily going to always have 10 stocks because market conditions don't allow us to do that. And again, that's what professionals do. What we're trying to get you is get you into basically hedge fund like performance without you having to have 10, 15, 20 million to get into a top tier hedge fund. Okay, and I ran a fund of hedge funds that had $184 million in it. You can look that up as well. It was the Blackthorn Fund. So these are things we've done before. And by the way, I'm going to try and do videos for you guys as often as I can. But the fact of the matter is that I actually trade and work during the week. You guys will actually get to see the person whose trades you're recommending on Fox News and on Bloomberg talking about these same trades. I'll tell you what, if you sign up now, I'll send you a Cheddar interview that I did this week where I listed these stocks out that are in this slide that I showed you. The actual stocks that I showed you, I talked about them on Cheddar. I don't know if any of you know what Cheddar is, but it's an online business channel. So I'm on there once a week or so, and I actually talked about those stocks. So I didn't go through each one and say why we like them because you just don't have time to do that, but I get to do that with you guys if you join. So that's pretty cool. But yeah, you'll actually get to see, I'm currently still on TV. So you might see me on TV go and say, hey, I really like, here, let me look at our current portfolio real quick. That'll help me. I really like, sorry, give me 1 second. I really like Electronic Arts. We're in it about $91, fell a little bit this week. We really like it because people are quarantined and they're going to be buying more games. All right, and here's the chart pattern we're looking at. You get to watch your actual, God, what am I calling myself? I hate guru. Your advisor, how's that? The portfolio manager of the stock think tank. You get to actually watch me on TV talk about these same stocks that you guys are already in. All right. Are there any more questions, guys? There is a March 25th special webinar. If you join now, 5 p.m. Eastern time, again, live market analysis, trade updates if there are any. I have Mike Arnold on that as well. Please consider joining this because this is the time to join this. You don't want to go it alone right now. And I'm talking about portfolio people and active investors. This is the kind of thing that down the road, you're going to be able to say, I bought these stocks at this price. And that's a fun thing to say. But what this really is for people who want to take this stuff seriously. That's what this really is for. Okay, if you just want to fart around and go to a party and say, I bought Apple, this is probably not for you. But if you're looking to be an actual serious person that builds a portfolio and actually has that portfolio 2 years, 3 years, 5 years from now and is able to show the returns. Do you discuss how to handle 401k and RIAs that we have at this time? Will I talk in general terms about that? But I'm not a registered advisor anymore. So it's not really my place to do that. But if you have individual questions that we talk, I hope to meet each and every member at some point, whether it's electronically or in person. You could ask me those questions. And if I feel I can responsibly answer them, I will. If I feel like it's an opinion and not a responsible answer, I won't. But I know enough people. I can send you to someone that will. What is your recommendation based on to use technical analysis? Frank, we do. So in the members area, you'll see a video describing the strategy. We have a screen that we use. It's a 9-point screen. And if a stock doesn't appear in that screen, it's not going to go in the portfolio. And then once we do that screen, we go through each one of those from a price action perspective and see which ones look like they're about to pop. And we get in those. It's really that simple. And that's 26 years for me, 27 years for Mike Arnold. So you're talking about almost 54 years of actual trading experience. Mike is my co-portfolio manager on this product. What else, guys? Anyone else? I want you to enjoy your Saturday and get out there, and I guess you can't. Okay, never mind. So any other questions? Ask me anything. Am I going to wash my hair today? Yeah, probably. Am I really Italian? 100%. And you know how you know if someone's actually really 100% Italian? They answer with, I'm 100% Italian. That's how they answer. Also, they go see Sebastian Maniscalco every time he comes to town. Thank you, Alan. I appreciate that. All right, so guys, there's limited spots I want to do at this price. There's actually not that many left. So if you're still here and you're thinking about joining, just go ahead and join. When you look at what the value is for this, I just don't like to say that I'm just not that arrogant. But if you just take $497 divided by 12, that's $41.50 a month, basically. $41.50 a month. Will we have access to your recordings, previous recordings? I'm not sure what that means because this is a new product, Neil. You can have access to anything I have access to as far as I'm concerned. We'll record all the special webinars and stuff. We do have a YouTube channel and stuff where we show everything to basically everybody, but the stuff that you guys are going to see as members it's not going to be available to anyone except members. So I don't particularly care for this thing to be giant. I really don't. I do remember that, Frank. Frank is a previous member. Do you remember my comment on chubby levels? I do remember you calling certain levels chubby. Yeah, Neil, so you're going to have access to everything that we create, everything that we record. And honestly, I mean, the people who join today are going to have access to me. Now, I don't know if that's a good thing or a bad thing. It might be a bad thing. You might decide it's a bad thing, but you're going to have access to, you know what, let me do this. I know I don't look good right now. And I'm kind of vain, so probably shouldn't do this, but I'm going to do this. There we go. I know that you guys some people want me to have the offer sheet up, but if you don't feel like you're going to take this seriously, and if this is not something that you understand what we're trying to do in this bear market that we're in, remember, we're going to be picking stocks when there might be 8, 10, 12 months left of downside, right? If you look at the bear market statistics I showed you. Now, the bear market in 1987, by the way, came out in 4 months. So in 4 months from now, you're going to be wanting to say, hey, what did you buy 4 months ago? I want to get in those now. Too late, right? Now, there might be downside to what we're doing going forward. We might pick some stocks that are lower. And I suspect, I haven't looked, but I suspect the portfolio itself probably lost money on Friday, right? It was up when we posted it. That image I have in the what do you call that thing? The PowerPoint. You can see I'm truly Italian. The image we have in the PowerPoint probably has gains in it, where it was probably on Friday, probably might have losses. I don't know. The T-Doc is doing pretty well. When you look from a perspective of what's going on in the market right now, you should not have to try and figure out what stocks to buy alone. You shouldn't. And if all you want to do is just say, I want to buy the stocks these guys are buying, that's fine, I guess. But just understand that that goes back to the original Neil question. What was your performance? Well, mine will be different than yours if you just want to buy the stocks that we're buying. But even if you're someone that operates on a margin account, given that we're doing a risk per trade, you can calculate that risk per trade so that you don't get hurt on margin either. And you have to use an amount of money on the risk per trade that you're comfortable losing. So this is exactly what I'm talking about. People want to do this stuff on their own, please feel free, go ahead. But if you want to actually have a professional portfolio, and there's no better time to have a professional portfolio than right now, when the professionals are starting to buy. Mark Cuban was on the other day saying he's buying. Bill Ackman was on the other day saying the world is ending, but he's buying. Think about that for a minute. The world is ending, but we're buying. Okay, so what do you mean? Either you're trying to get stocks lower so you can buy them cheaper, or you realize either the world is ending or these stocks are going to have value. It's one of those two things, right? Some of these guys I know. I don't know Cuban or Ackman. I don't. But I know Kumal Shri Kumar, who's actually going to be on our next show. He's just a massively, insanely smart economist. And he did not say he's buying, by the way. He doesn't make any recommendations. But he did predict this in October. And I've talked about this in videos. You guys are going to get that kind of knowledge and the kind of connections that I have that you can't get anywhere else. Now I don't want to look at myself anymore. So I need to stop doing that. So anyway, let's see. Let me look back here. I'm not seeing any more questions, but I'm honestly kind of happy to talk about this stuff forever. Slots going fast. I hope you guys join. I hope to talk to you guys again. And if you guys have any direct questions for me, I'm not in charge of the money side of this, by the way, and I'm not in charge of the offer side or any of this. So you guys can find me on Twitter at Bob_Iaccino. A lot of times people don't want to ask questions in these things. They don't know if they're going to be called out, blah, blah, blah. Go ahead and follow me on Twitter and hit me up on Twitter. I'll watch my Twitter all day today. I think probably this price is going to be gone. I don't know if we'll be on through the weekend or not. It's not what I do. All right. I'm busy with the analysis and the trading. So from a perspective of how long it's going to be there, I don't know, but this is an introductory offer. There were no members of this product before this webinar started. We now have double-digit members already, so that's good. But going forward, this price will go up because I'm not going to do this work for free. It's just that simple. So anyway, guys, thanks for the time. Jeanette, TradeThirsty, all you guys, thanks for all you've done from the time, Jeanette, that you and I sat down in New York to get to here. It was really Jeanette's urging to do this product, and I'll tell you what, she likes to say she's not a trader. She is. Her and I were talking about in New York about how this is probably what was going to happen. You can go back and find October, BNN Canada, BNN Bloomberg Canada is one of the places where in October, I was telling Catherine Murphy, who was one of the hosts there, that every single stock position we buy is risk controlled now. You can go back and see that. And you can see that we were talking about this, right? So yeah, that's it, guys. Cheers. I'm going to go. If there's anything else, you can find me on Twitter. Like I said, I'll watch my Twitter account all day today. I'll be home. We know that. So you can follow me on Twitter and reach out to me. My comments are open there, and my direct message on Twitter is open. Jeanette,